So
Well, good morning. We're here for the Power Hour, and I'm going to go ahead and talk this Netflix thing now that Janae, you all didn't hear the conversation of Janae, but she was saying that it jumped up, and so she was, her strike was threatened on Netflix, so she got a little concerned. Two things here I will say. Okay, of course, the gap up left room, and a lot of stocks don't like to leave their gaps. So when you know a stock and you know how it functions with its gaps, you kind of get an understanding of how does it do. Does Netflix usually close its gaps? And if you are one who follows a stock, that's something that you would look at regularly to see, does a stock go back and fill its gap quickly? Does it, how does it kind of function? This is why you can watch one or two things, so you really get a good idea. In this case, Netflix did come on back and fill its gap on Friday. The other thing I want us to keep in mind, the one thing that I push about credit spreads and the weeklies is that it allows us to stay away from the screens. Right? Credit spreads is the kind of thing that you can open up your trade. You can set your stop loss if you choose. You can set your take profit order, and it does not require all day watching. But if you choose to all day watch, regular day watch, then you're going to get that roller coaster ride. And I'm not just talking to Janae, I'm talking in general. If you got something for the week and you watch the price action all week, you're going to take yourself on the emotional roller coaster, right? Set your things and say, okay, I'm getting into this trade. I've got whatever strike I'm getting. I'm setting up my 2x or my 3x stop loss. I'm putting that on, or I'm putting on an alert that at least lets me know that it's coming closer to my strike. Even if you don't want to set the stop loss as an order, maybe you want to set an alert that says, I want to know when it's getting close to my strike, and then you go, as best you can off and do the rest of the things that you're going to do, because this is why we, like to use credit spreads, because they can allow us not to have to watch it. Of course, if you're buying a call or you're buying a put, you're going to have to watch to see what the good exit and entry. You don't have to do that when you're a seller. You literally can say, I'm in for this price. I'm going to set my stop loss order in place. And then when it hits that, or my alert in place, and when it hits that, I'm going to be gone. So tell me, Janae, do you remember what you took in premiums?
yeah, it was 62 cents.
Okay, it was a 5 spread.
Yeah,
Okay, so we took in
24.
$62.
Two contracts for 124.
Okay, so 124. Let's just go with the one contract, because you're going to set your stop loss and that kind of thing based on the one contract. So 0.62 is $62 that was received, okay? You can say, okay, I'm going with a stop loss of, I'm putting SL is our stop loss. If you want to do a stop loss of 2x, which basically is 2 times what you received, that's going to be the $62 times 2. Right? This is 124. So what you're going to put in the limit box as a stop loss order, I think it's called a loss limit or a stop limit in Thinkorswim, you would put in 1.24. Okay. It can be a hard, you can put the order in. That way it's gonna happen whether you're watching it or not. Or you can just in your mind know, if it gets to 1.24, I'm out. Or you can do a stop loss of 3x, right? And for credit spreads, depending on where you were, I'm more a fan of 3x, because credit spreads can get close to your strike but not be breached. So you need a little more room when you're working with credit spreads. So I like 3x. So that's going to take this, either one, 2.5, 3, you choose what is comfortable for you. That's 62 times 3, which is what, 186? 186. So in the stop loss box, you're going to put 1.86. That's what you're going to put in the box. So let's talk about, if you pick a 2x stop loss, how much money are you losing? Right? This means of your money, you are losing $62, because you're going to put in 1.24. The broker gave you this $62, and you're gonna put up 62 of your own dollars. So your money, you're losing $62 if you're doing a 2X. If you do a 3X, then you are losing $124. Okay, you are losing $124, and that's because the broker gave you this $62 up at the top, and you're putting up the rest of the money, which is 124. So you're asking yourself on the front side, how far am I willing to go as far as price and, value of this spread? Which one am I more comfortable with? You can put this stop loss on as a stop limit order. You can do a OCO order, which basically you've got a stop limit one place and you've got to take profit. Basically, you can have that put in as a one cancels the other. That's what OCO stands for. Order cancels order, I believe. And that basically says if it gets down to where I want to close it for a profit, or if it goes up to where I want to close it for a loss, it's going to trigger whichever one it gets to first, right? This is where you're determining your stop loss for credit spreads. I've been in the past where sometimes I would let the trade go because I'm hoping the price would come back and do what it's supposed to do. And sometimes it does. But then when it doesn't, you're like, I should have did my stop loss back when I could have. Yep, this is very true. And that has happened to me more times than I literally want to share. But if we got some kind of stop loss plan, it can help us out. All right. Who does not understand what just happened or has more questions about the stop losses?
This is Wesley.
Mhm.
Can you enter that in Thinkorswim? That's the platform I use,
Mhm.
and that's where I think I lost it at because I did all of that, because you've told us all of that, but when I put it in, maybe I put it in because I think it's GTC good to close, and
Good to cancel.
again it canceled right away. So I'm thinking maybe I did it wrong.
Okay. So
You know what? Can you add to that? I don't know about wrong. Um, Coach, can you also share that when you're closing there, outside of the spread or in addition to the spread, there got to be a buyer. And so that premium when you close in has to be attractive to somebody to take, right? Because this isn't artificial outside of the sim. This is real. This is somebody who really said, oh, I like that premium, I'll take it. And so I know when I did my close, I think I know the spread it was I know it looked a little juicy. I think it was like 50 cents on it, or maybe right at right right under there, right about that. So that did still look attractive to somebody. So can you talk a little bit about that part too?
what was your strike that you had, Janae, for your trade? You had
940, 945.
Okay. Okay, so I've turned on demand. For those of you who have Thinkorswim, I have turned on demand up here in the top right. You can see it, and I've taken us back to Monday, December the 9th. Now, I'm not sure which day Janae got in, but I'm got us on December the 9th, and I'm gonna take us into the general area where she was, 940, 945. I'm gonna get us a vertical, and we'll set the trade. I'll start it, and then we'll see
I got in at Monday 248.
at 2:48 in the afternoon. Okay. Well, look at you. Because at 9 something in the morning, which would have been a little early.
Yeah,
Let's
and
see.
things
Okay.
weren't where
So
they were. Yeah. So in the afternoon, I was like, oh,
mhm. Looks like this is about 2:30.
again, only wanted a day, just one day, just wanted one day.
Yeah, well, I'm telling you, Thinkorswim, for those of you who have Thinkorswim, on demand is a precious resource inside of Thinkorswim. It's one of I'm not sure of any others who really have an on demand that allows you to go back to whatever time in the market and basically operate just like the market is working, regular time. I'm looking at it, it's $75. Now I'm gonna go ahead and push it just so we can see this is a nice round number. I like that. This is basically us getting into the trade right now, and we're taking in $75 for 940, 945. Let's make sure that it's on and popping. No, I don't want it to be working. I want it to be on. Uh-oh, let me turn. Oh, it's running. Come on, pick up the trade so we can be good. Okay, I'm going to erase all this stuff up here so we can see what's happening. There we go. Come on, baby. You can start the trade. Come on, baby. Okay, let me cancel. It's getting it. Now it's paying the $62 that you got.
That would be the on demand.
$62. So you were mentioning making sure there's a buyer on the other side. This is one of the reasons too that you try to work with very liquid stocks, the ones that have a lot of volume. Let me change this and just get whatever we get. I'm gonna take off the word limit and make it market. That way it'll pick up.
Yeah, that's the other part that was critical. I will say that. Volume makes a difference.
Volume
Getting
makes a
out,
difference.
especially if you want to get out.
Yeah. Alrighty, so in this case, we did take in $75 on this trade. So now let's go. The trade is on and popping. So let's go look at what do we do if we want to set our stop loss. I'm picking, okay, so I picked one of these lines, right? The trade, and then I click the other one. So now they're both blue. I right click, it pops up, create the closing order, and you're going to buy the vertical on Netflix. So now we want to go over here to order where it says limit, and we're changing it to stop limit. We're changing it to stop limit. Now, do we want to do the OCO right here? Or do we want to do just the stop limit? Let's do the OCO because more people have trouble with figuring out the OCO. I'm going to delete this and we'll start again. So that way you can see exactly what's happening here. All right. And then you can look back at the video recording. Both of these are blue. Right click, create the closing order, buy the vertical. That pops up. Under here where it says single order, y'all see my mouse here where it says single order, we need to change this to OCO. And I think people go first trigger OCO. I think some of these, the OCO, I think it's order cancels order. Just go with first triggers, okay? And then once you have first triggers OCO, then now you got to go over here to the right in order to duplicate. You got to go over here to duplicate the order. Come on, let me in. There it is, right next to it. What just happened? Oh, I'm like, where did that go? Whoop. Okay, I don't want you. I don't want you, baby. We're going right here next to this order where the gear shift is and clicking on the gear shift. Maybe I do want that, but I wanted the one that says duplicate. Why is it not giving me the option to duplicate? If somebody's with me and they see I'm pushing the wrong thing, then let me know. I thought it was right here. Oh, here we go. Now I see where I was. Over here to the right, where these lines are, way over to the right. I hope y'all can see my mouse way over here. We click on this, and then it pops up to say create duplicate order. Create duplicate order. Okay, now we've got two orders right here. One of these needs to be, the first one we're going to change from limit to stop limit. This is basically our stop loss. And if we decided we're going to do, right, 75 times 2 is 1.5. I'm putting that in, and it's a dead. I'm back.
Oh, okay, I thought that was me. It's like,
Nope.
no.
No, it's not you. It's the system shut down. Okay, let me share my screen again. The recording should still be going. Alrighty. Okay, wait, I saw a comment. Let me make sure I'm getting all the questions answered. Okay, so I was here. I'm not sure if y'all caught this part. I made the stop limit 1.5 because we took in $75 and 2 times 75 is 1.5. This is where I put for our stop limit. All right. Then we can say, what's our take profit? If we want to have our take profit. Now, I don't like when this does this here. It says standard, but I usually put the same thing in this box to make sure there ain't no problems. Okay. This other one here is where we're putting in the take profit. Okay, so we got in for 75. Let's say we want to get out for 15. I just pick the number, whatever your profit target would be for a $75 trade. You know, if you wanted 20% of that would be 15. Yep. So if you want to keep 80% of the money, 0.15. You said, okay, if it gets down to 0.15, I also want it to close. If it gets up to 1.5, I want it to close. Make sure you change this here from day to GTC, which means good till canceled. It stays good till canceled because the day means it's only going to be enforced today. This order will only be enforced today. If you do GTC, that means if it happens tomorrow or the next day, the order will still be sitting there. You don't have to reset the order every day. You set it one time, right? 1.5. Is Jamie on here? Did I lose some people? Looks like I lost some folks. Jamie, are you here? Nope, I don't see him. Okay. Stop limit, STDs, limit. Okay, everybody who's looking at this agrees with what it looks like. This box down here is the one that I have to always remember what to do with this second little box down here with this 1.5. Okay, once we've got all this set, we can hit confirm and send. Okay, it says here, it's going to buy back a vertical at stop limit 1.5, or it's going to buy the vertical at $15. You know, you can read what it's talking about up here. And then when you're ready, you can send it. Once you have it sent, it should be, if you click monitor, it should be up here in the working orders, and you should be able to read what it says. It says, okay, 1.5 limit, 1.5 is the stop. And if it's get down to $15, it's also, and then this mark box here will tell you where it currently is. Mark is what is the current price, what's currently happening with this trade. It's worth $50 right now. So it's not at 15 and it's not at 1.5. It's not at 15 and not at 1.5. It's in the middle. So if you decide, even along the way, you might decide, I won't, you know, I'll close it for less than 15 and I'll just take my profits. You can adjust these pieces. You can go off to the left here. You can always, you know, right click over here to the left and cancel, replace, and change it to something else. You cancel, replace, order. It should pop back up and you say, well, I said 15, but I'm probably okay with 30. And you can change it, cancel, replace, confirm, and send it. And then when you look at monitor, it has adjusted. It says, okay, now if it get down to $30, let me out, but I still have the 1.5 one here. And these two orders are working together. Okay, they're working together. What questions do we have? Mr. Mack, is this clearer to what to do when you're trying to set your close orders?
It is. but I didn't do none of that. I just did the good to the GTC straight away. I didn't do like you did to set the limit both ways, which I
Yeah.
think is better. Now, one question I had: do you set that at even when you're doing iron condor, you have to set it for both sides of the strikes on the iron condor?
Now, usually what I do, generally, I don't necessarily always set the stop loss, but I always set a take profit order. So the reason I do that is because once I set a take profit order, I can then watch just this screen and see what is this doing. If this number over here to the left and to the right, if this mark number is going up, I know it's getting closer to my strike. If this mark number is going down, I know we're getting close. So it's a way for me to watch the trade without actually watching the chart and watching all the price action. I can just leave it on this screen and do other things. So, but the answer is yeah, even if with an iron condor, when I was doing triple Qs, I did do that because the price could be going either way. So yeah, you can do that. I want to be sure, Mr. Mack, that when you're looking at your closing of your trade, right? If you're looking at a close here, this is what I think might have happened, even if you were doing just the stop, right? This is not gonna let me put another order in, but if we were doing this and you were doing the stop limit, notice how these two boxes need something. You got to put something in both of these boxes.
Yeah.
Okay, so 1.5. See, if you leave this one at 75, it may trigger because it's currently at this price, right? So you have to make sure that when you're setting your close order that you set it that you do both of these boxes. There's stop
Okay.
limit, there's a stop, you can just push stop. And stop is just, you can put that, if you just want to stop, you can put this price in here then too. And then you only have to fill in one box. But you need to make sure that you change this price to whatever you want as your stop loss.
And one of them had, you warned us last time, if it skips over your number, if it jumps your number, it won't stop.
Nope,
It'll keep
nope.
going. Is
It
that
will
with
keep
the
going.
stop mark or is that with
That's
the
with
other
either
one?
one. If it jump,
Oh,
because
okay.
basically it's going to pick up this order when it's worth this. If it's not worth this, then it won't. I think the stop limit, though, I want to say one of them will, if it gets beyond it. Thinking. I'm trying to think of what it says when it gets beyond it, because it basically won't stop you out for less than this, but it will stop you out for more. But if it'll stop you out at whatever it's worth.
Okay.
So it may go beyond what you pick, but it won't do less than what you picked.
Got it.
Or is it the other way around? Let me see. All right, this is not going to take because I already got that one order in there. But okay, so are we clear on what to do to set our stops? Now this is all in
Wait,
Thinkorswim.
one more time. Can you go back to that last screen
Mm-hmm,
that you was at?
mm-hmm,
There's something, it's just another question
uh-huh.
I had. And no, set it up as if you're gonna do take profits. Yeah, please. Now, see that number down there, the mid and the NAT, that number there, that's saying, if I'm understanding this correctly, that's saying that that price is between that number, the mid, and the NAT number. That is, so if you're going to set a stop loss, you need to set a stop loss outside of that range. Because if you set it inside that
Yes,
range, it could go and
yes,
grab it, stop
yes,
it, and keep moving or whatever it's going to do.
absolutely.
That's
Yep.
what I did wrong. That's what I did wrong. I'm
Yep.
sorry, I'm getting excited, but that's what I did. I should have set it outside that NAT number because I tried to do in the middle,
Oh,
and that was the problem.
because
I
there's
think,
still orders because there's
yes.
orders all in here. It's just if you pick a number in here, it may pick up. Yeah, we don't want
Okay.
that. Okay.
All right. Okay. I got it.
Yepper. Okay. All righty.
What did you call it, Coach? You said You may not set a stop limit, but I mean a stop order, but you take what you call it, a take profit?
Uh-huh.
Is that what you called it?
Yeah,
And you're usually that's your 50, 70-ish percentage
right,
that you already designate ahead of time. Okay.
right. That means I'm gonna take profit. I'm gonna get my profits out of there. Of course, if we're going the other way, I'm not getting no profits. I'm just closing. If it's going the other direction, there is no taking profit. It's more like I'm setting a stop loss. I'm going to set a loss, but take profit would be anything less than what than what I took in is a take profit.
That part.
Mhm.
Because sometimes getting out, and if it's like right upon expiration or there's nothing there, of course you can't get out. If they won't let you, it's but in
It's
case
only
it's
what you
like,
want to get out at, because sometimes if you're trying to get out at $5 and it won't get below 10, then you're right, you won't get out. But if you change it,
right,
you can get out.
that part too. That's the other part.
You
In
change it
terms
to
of having
what
in
it's
terms of
worth.
having a buyer to buy you out, like a
Yeah.
real buyer to actually get out. Because you could be favorable and you're like, well, I want to get out. But yeah, no, they don't see a little 3 cents, $3 as a profit to take.
Yeah. Yeah. So let's look, I'm gonna look real quick at Robinhood so for those people who are on Robinhood, I think we talked about this a little bit on Thursday, but let's hit it again. So if you are in a trade and you want to set a stop loss or you want to set a limit, let's say for example, this BBAI trade is, the price has dropped. I'm wanting $30 to get out, but it's above that now because the price has come. I was selling a put. Okay, so I'm going to cancel this order so we can see from the beginning what happens. So BBAI, this is not a spread, but it is a trade that is a sell trade. So I'm going to show you what do you do on Robinhood if you're trying to set and get out or set the orders to get out, right? So once you open up the trade, my computer's moving so slow. Okay, I got a plan. Lisa, your camera's open. Okay, cool. As long as you know it's open.
Sorry, I didn't know.
No, I wanted to make sure that you didn't show us anything you didn't want us to see.
Thank you.
BBAI. So this stock is currently at $2. Let me see if I can make this a little bigger. There we go. It's currently at $2.52, and I have a $4. I'm selling a put, so I want it to stay above $4, and it's at $2.52. Okay, so this is not where we want it to be going. So if I want to buy to close it, let's say I just was going to set the order to buy to close it, and it says, it showed you here, the limit price now is between 135 and 175. But if I was setting myself now Robinhood doesn't let you do that whole OCO thing. You basically, you set it to close with a profit, or you set it to close with a stop loss. So buy to close is what we're doing because I sold to open one contract. Now, if I want to put it here, if I want to stop loss, I need to go outside of this bid and ask that, like Mr. Mack was just saying, I would need to go there. If I let it fill on its own, the 155, it's right in the middle, and it's going to pick up, quote unquote, right away. Today's Saturday, so it's not going to pick up today. But if the market was open and it was set at the 155, it would pick up. So let's say I got good till canceled here, but I'm thinking I really would like to close it at $30, right? I want to set it at close $30. It's not worth that right now. It's worth $155, right? So it's going to say here, what's the order, review order? Okay, so here we go. That's a limit order. Limit order is regular. So if I was setting my take profit order would be this one. But notice when I went up here to this drop down box, it gave us a stop limit order opportunity. So limit order is where you're taking profit. A stop limit order is just like a stop loss, just like it was on Thinkorswim. Okay, if I want my stop price at 155, okay, this lets you put a limit price, like I want to be, or want $30, but I want to close it if it gets to $2, take me out. This is where you get the same, this is Robinhood's version of OCO. The limit price is what I want for my take profit. Okay, this is what I would want. This is the price here I would want for my profit order. I want to close it with my money where I get some money out of it, right? This would be like the profit order. And stop price, this is my stop loss order. I'm saying if it gets up this high, then close me out, take me out of this too. All righty. And then when you're satisfied with what you put here, then you push review order. It's going to tell you what all it's doing, and then you can submit. Okay, the order is.
Excuse me.
Yes, ma'am.
I had a question.
Yep.
If you put that in and price opens gapped up over your order, or it reaches that in after hours, will it close it?
An options contract will not close after hours. So we're talking about options. So if it reaches that price, it won't do any closing after hours. It won't catch any of these orders until the market is.
Okay.
Hey, baby.
Oh, I'm sorry.
That's all right.
That's my nephew. That's my nephew. I'm sorry.
Hey, nephew. Welcome to the call. Okay, so yeah, it won't do no options orders will pick up while the market is closed. But when the market opens, if it hits either one of these, it will pick up when the market is open. Okay, told y'all Robinhood trying to come along, and because Robinhood used to not have a stop loss ability. You had to put that order in as a single order, but now they coming on up. And when you're done, of course, you can just pick done. Okay. That's for those who are on Robinhood. All righty, what other questions we got here?
I have a question.
Mm-hmm.
Alyssa, I had a credit spread a long time ago that was still loss-making.
Mm-hmm.
Even though because I think it went in the wrong direction, but it didn't hit my credit spread. So let's say I had a bull put spread, and let's say it was XPX, I don't know, 6,000 or 5,900 or something, and it went the opposite direction that I thought it would. So I thought it was going to go up, and then it went down, but it didn't. It didn't hit the actual credit spread, but I didn't make that money. So is it that
make that money?
I didn't make that full amount because it was negative, but it wasn't breached. So I'm just saying, in principle, does it have to be that direction the entire time for you to make the max profit?
So what it has to do is, especially with the cash settles, it has to be worth, once the market closes, is it worth, or what is it worth when the market closes? That's really what it's going to come down to. What is it worth at expiration? So in the situation where you took in, let's do $75. You took in $75 on the spread. So this was your premiums that you received. But at the end of the day, it's close, and it's now worth $90 at expiration. If it's worth more, because remember, SPX is cash settled. So you took in a premium of $75, but at the expiration, it was worth $90. That's going to be a minus. So at the end of the time, you're at a negative $15. So it's going to go with what is the value of that trade at the end of the day. And this is going to come down to like proximity, like how close is it? Did your trade really draw down to zero, or did it draw down to whatever? And generally implied volatility is what will keep it up here. If there's
Mm,
if like an earnings call is gonna come up tonight, or there's some data that's coming after, something like that can keep the implied volatility high. But if the implied
Mm.
volatility isn't there, it should draw down to where you are still in profit. Or even if it drew down to you know, in your case, it might have drawn down to maybe it went down to it was worth $50.
mm,
So it didn't draw down to zero. You're still going to get $25. You know, you're going to keep $25 in profits. That's not going to be the whole 75. And this doesn't happen a lot, but I do know what you're saying. I've seen it happen
mm,
before where trade was over, but it was still worth $10. And I'm like, wait, no, that happened to me.
mm,
I had a
mm.
trade where I got in for like 20, and at the end of the expiration, it was worth 35. And I was like, but it's not even at my strike. Why did I?
Yes.
Yeah, it's because it was worth 35 at expiration, even though I took in 20. It was worth more than what I had taken in, so I lost $15. It sucks.
Okay.
Yeah.
So should we enter low IV or high IV spreads to
Well,
avoid
we
that
like
risk?
high IV because high IV gives us more money. High IV gives us more premiums, but you got to keep in mind, you know, it's worth what it's worth at the end. Ugh.
Mm,
Yeah. That's a hard one to call, whether you do, because if you do too low IV, there's no money there. We want money.
mm,
We're here for the money.
mm,
We're not here for just to say I'm a trader. We're here for the money of being a trader.
mm. Okay, thank you.
Oh, you're welcome.
'Cause I was very confused when that happened.
Yeah, I was too. I was so mad. I think it was like XLY or something like that for me, and I quit trading it after that. I was like, "You're just gonna play with me," because it was like dollars. In my case, it was several dollars away from my strike, and I still ended up.
Yeah.
I was like, "Oh yeah, no, you are off the list." Might have been like XLI or something. I was like, "Oh no, I'm good on you. Let me go on to something else that's gonna play right, because you're not
Yeah.
going with me." Mm-hmm. Okay, well, let's look to see what kind of trades we can look at that we potentially could have for next week. Right? So let me bring it over to the main screen. This is where we
Miss,
look. Yep, I'm listening.
can you go back to that chart you just had? And I
Yep.
don't want to belabor this, but it
Mhm.
bugs me.
Okay.
Let's say, for example, on this, let's
Mhm.
say you're going to set your entry. You did a put credit spread. I'm at 11.4, right on the bottom of the red candle on 11.4. So
Mhm.
let's say you're going to put your call credit, no, your PCS in.
Mhm.
So you're going to be right at the 56.50 or 65.50 mark. You're
Mhm.
going right
You're
below that.
at 11.4?
Yeah, right below where you're at. Go right
Uh-huh.
below that candle, and that's where
Mhm.
you're going to set your entry.
Okay.
All right. So let's say it's 2 o'clock.
Mhm.
By 4 o'clock, you expect the cost of that credit spread to be what at the top of the green candle? What would you expect that credit spread to be worth you in the same day?
Mhm. Well, if it's 4 o'clock and you got in for some, I'm expecting by 4 o'clock that my trade from down here is worth zero.
Okay.
I want it to
Okay.
be worthless by that time, especially because that's a big green candle. I would expect it to be worth nothing or very close to it.
Right, because what I'm thinking, maybe I'm wrong, and I'm trying to understand this, is that when I enter a call credit spread, wherever I enter it at, if that price is moving up, because I put it's a PCS, I put credit spread, so I expect the price to go up.
Right.
So when the price moves away from my strikes,
Mhm.
I'm assuming that my strikes will be more profitable.
Yes.
But when it goes to the top up there and starts to come back down,
Mhm.
those strikes will be less profitable because why?
Yes.
Price is retracing back towards
Yes.
your strike prices.
Yes.
Am I thinking right?
Yes.
Okay. So the next day, let's say it's going to expire the next day on, let's say 11/25. So
Okay.
whenever I want that, whenever I'm going to close my strike on, let's say Friday,
Mhm.
I want price to be at a position as far away from my strikes as possible,
Mm-hmm.
regardless of it, what time it is on Friday.
Mm-hmm.
It ain't gonna reach its maximum benefit to me until the price is as far away. Because if it's still retracing back on Friday towards my strike price, even though I got $300, when I go to close it, it may be less. It may cost me more than $300, not more, but less. I thought I was going to make 300, but because price retraced back towards my strikes on Friday, that trade will maybe only be worth 200. Am
It
I
has to
thinking
be
right?
retracing. It had to be retracing really closely. So let's say you got in,
Okay.
if you got in down here,
Yes.
and then you get to Friday, this is, even if it's coming back down, it's still got a long way to go to get back to your strike. So it needs to be, I mean, at the money strikes generally are worth about 250. At the money trades, if you got in at the money, generally it's worth 250. So unless this is coming back towards at the money of your strike, you should still be in a good profit because you got two things working. The price action, so price being away from your strike is one piece. And theta is also taking the premiums down. And that happens mostly on Friday, Janae. That happens really a lot on Friday. Janae looking for theta to kick in strong on a Tuesday. It's
And that's what
happening
I thought. I thought
Friday.
theta was kicking in on Tuesday, Wednesday, Thursday. So by
It
the time
is.
Friday
It
came
is
along,
working, but it's not working anywhere
as
near as
much.
fast as Friday. Friday is
Okay.
where it starts to like, I don't got a lot of time left, and it starts to run faster. Theta is working
Okay.
on Monday and Tuesday and Wednesday. It is, but it speeds up on Friday afternoon.
I got you. Okay then. All
So
right.
if you get to Friday though, and your proximity, if you're far away from your strike, even if price is coming down some, that's still okay. You're far enough away and time is winding up, then you should still be getting down to closer to zero. Now, if you get to Friday and this is your strike down here, and you get to Friday and the candle is wicking down here, then that's probably gonna be closer to 300 or closer to 250. And you've got theta, but price action is still dancing around near your strike. This is gonna be more expensive down here than if price is all the way up here on a Friday and this was your strike down here at the bottom.
Okay. Is that why you're so adamant to say, hey, guys, take 80%, 85%,
That
because it's
is.
not worth it waiting until the end for that price to retrace and then it blows through your strike and now
Yes.
you have anything, you have nothing.
Yes. Because
Okay.
it could be going the right direction all week. And if Friday is a drop off and it dropped back down here, the whole point is it's worth what it's worth at expiration that matters. It don't matter what it did all week. It could do all this dancing around all week. But if it dropped back down here to your strike on Friday at 4 o'clock, your trade could be breached. And you could have been like, it was good all week. When it's good all week, you need to go ahead and close 80, 85. Make sure you take your money off the table. Leave that little extra $15, $20 or whatever it happens to be. I won't say little because $15, $20 is a lot of money. But whatever it is, those last few hours, if you can get out earlier with your profits, you should, right? Just because if anything could happen on Friday, or your trade could be going fine, your call credit spread could be going fine all week, and then Friday it gets on a horse like SPX will do and run right up past your strike, and you're like, what in the world happened? I was good all week. Next thing you know, your call credit spread breached.
Yeah.
Yes. And we do know that Mondays and Fridays do seem to be very bullish. It's weird how that happens. And of course, nothing's everything, but it does do that.
Okay. One last question then for me concerning this week. I looked out and next week is that triple witching, quadruple witching stuff you talk about. So
Yeah.
I'm just wondering when you look at next week, what is your thoughts on that?
Generally, what happens during this actually is quad witching is coming because it's December. So quad witching is actually Friday, which includes people. There's gonna be lots of happening this week because people are closing off their yearlies, people are closing off their monthlies, people are closing out their weeklies. The bonds are closing, leaps are closing. I mean, all the stuff is happening this coming Friday. So generally during a quad witching, you can kind of go back and look at the different you know, 4 times a month, 4 times a year, sorry, not 4 times a month, 4 times a year. Generally, the beginning of the week or earlier in the week, it may show like it's bearish because people are closing positions. But then there's people like toward the end of the week and the end of the day, people start to reset their positions for the next year, or they reset for the next quarter or whatever. So you'll see there be an uptick. So generally, you'll see a pullback, a little bit of a pullback as people sell and close their positions, and then you'll see a pickup because people will reset. And once you reset and start buying and yada yada, folks are closing off their money for the year. They're closing out their trading for the year, going into the holidays. You know, those big brokerage firms also know their people getting ready. If they're having Christmas parties and going on vacations, they getting their bonuses, you know. So kind of expect there to be a lot of volatility. That's really the basic. Expect a lot of volatility this week. Expect that. So, you know, you trade based on what you're comfortable with. I personally would keep it light because it's just going to be volatile. Keep it light, keep it tight. But watch your stops. You know, make sure if you're going to trade a little bit, if you're going to make some money, make a little bit. I think there's also an announcement. I think is FOMC gonna make an announcement this week? I feel like I saw something that talked about
Yeah, on Wednesday.
Yeah, I felt like I saw something about that this week too. And if that happens, of course, that's gonna add its own level of volatility.
Yeah, so it's the interest rate decision.
Yes, so of course that's gonna have its own piece in the midst of all the other stuff that's happening. That'll also be there. What this
Sound
is
like
just
we
Alyssa,
should be out of the market by Wednesday.
You know, this might be a go Christmas shopping week if you Christmas shopping. FOMC statement is happening on Wednesday afternoon at 2:00. So yep, it's a lot. And then Friday, of course, is quad witching. If you got one baby that you like, just play with, you know, just play with your one baby and go on with that, right?
So Alyssa, with quad witching, is it because most people are selling, we're expecting a down, down slump in general on Friday with a pickup next Monday or
Well, the
something like
general,
that?
it's kind of from what I've seen in the past, and of course, nothing's ever everything. I've seen it start to slump earlier in the week. So I've seen it like do a little bit of dip early in the week and then recover going into Friday because people are resetting Thursday and Friday, they're resetting. That's what
Okay.
I've seen. You can see the week being a bit of a bearish week, and then it picks up toward the end of it as people are reset for next year. People are buying, quad witching times where people buy leaps because the price usually pulls back. So people will buy leaps and buy out a year from now, and maybe that opportunity for that.
Okay.
They setting for 2026 because some folks just buy SPX at one time and let it ride on. Some folks don't fight with SPX every day like we do. They buy it one time and let it go. They buy SPY once and let it go, or whatever one you're using. And here we are, we fight with it every day. Which yesterday we as a unit did, for those, but Tanya said she don't even trade SPX, but she was sweating yesterday afternoon.
I was watching y'all trades because Google did me dirty, so we broke up.
That's what Mr. Mack was just saying. Google got him too. He said Google did me dirty, so we broke up. Where did I put that? I'm looking for there it is. No, is that it?
I just have one question, Alyssa. The small the small account growth challenge. Can you tell us more about that? So, or like, when do we start? How would you like it to work, etc.? I'm really interested.
Cool. So our small account growth accelerator, it's not really a challenge per se, it's a growth accelerator. We're going to start with, $1,000, a couple thousand, whichever you're comfortable, 500, whatever you start. I mean, start where you start, right? We're going to basically, our challenge or the objective
Accelerator.
Yes, our acceleration, our objective is to grow that money over, definitely a 6-month period of time, but to put our systems in place, we'll do some trades together, maybe suggested trades, and whether you do them or not will be up to you, but we'll do some trades together and we'll grow that money. Hopefully a good mix of credit spreads and cash secure puts, covered calls, kind of a good mix of the things that we do, and grow that money by at least 10% a week. So if we do, $1,000, we put another $100 in there for that week. And then, the next week we're still using that money, and you continue to grow it you compound it as you go. We're looking at least 10% a week. And we know we can get 10% a week, even if we we won't use the whole 1,000. So let's say you're starting with $1,000. We're only going to use maybe 700 of it each week. So we'll leave some money, some cushion. We won't use the whole 1,000. Let me get us a screen so I can write on. We won't use the whole 1,000, but we'll use maybe 700 or 800. And then every week we'll compound that. The plan is to compound it so that way we can grow it in a consistent, steady way without being risky. So I'm not part of the challenge. May include, $100 of an XSP a couple times, maybe something like that, or a triple Q, but not really doing a whole lot of the daily stuff, because there's, anytime you're doing 0 DTE, you're increasing the risk. And I want it to be something that is consistent and conservative. So that way we can grow the money and not have to watch, because of course a daily XSP means you got to watch that. And I want us to be able to do it without having to do a whole lot of watching. Those are my thoughts.
Thank you.
Everything's happening within the membership. This is not like it's open to the public from the standpoint of the public can come join the membership to do it with us. So it's not my other programs. I've done things where I've just opened it, and then I would meet for the program, and then the members could come if they wanted to. That's not how we're doing it going in 2025. We're doing the trainings within the membership. That way we've got the group, we've got a place for us to communicate together, we've got, our Telegram, we've got places for us to get help, and we're training all along the way. It's all the things. And I really want the people in the membership to experience good growth and growing of their accounts as a unit.
Hallelujah. We receive.
We receive. Now, I can't stop you from doing other, because people be in the group, but then they still be doing other stuff. And then sometimes that's how we lose our money, is because we're doing other things. But I'm going to be here for what I'm here for.
Thanks, Alyssa. How long do you want to run it for?
I'm going to run it. We're going to run it for at least 6 months.
Wonderful.
So this is what we're doing inside of the membership. We're accelerating our growth as a unit.
Thank you so much.
You're welcome. We're going to continue to work together and get ourselves all confident and comfortable in doing credit spreads. Because sometimes I know we felt like this. I have even felt like this when I'm in the midst of a unit. Is if I feel like I'm operating on my own, sometimes I can feel like if it doesn't go well, then I can feel that loss on my own. But if we're all working together, then that working together can help us all feel the group confidence. If it goes well, we all do well together. If it doesn't go well, we commiserate together. So that's how we'll do. Okay?
Okay.
Thanks for asking that question, so that way I could explain to everybody. Okay? Janae saying, take care. You leaving? Did Janae leave? He said, take care. Okay. Hey, Valerie. Hey, Carolyn. Hey, y'all that came on. Hey, Jay.
Hello.
Hey, Shanna.
Hey.
Hey. Okay.
Thank you.
Hello. What'd you say?
Thank you for, I'm excited about 2025, where we're going, because it could be consistent and then it's scattered. I'm like, okay, why am I doing this? But anyway.
We all work together. We got a better chance.
Yeah, looking forward to consistency as well.
And I know we're gonna continue, some people will continue to incorporate the SPX on the daily, and that's fine. I think as you're the CEO of your own portfolio, but there's some things we'll do together. And if you decide you want to do some extras on your own, then of course that is fine. We're still here. The SPX trading that every day is something we do as a group too. So that's cool. All of that goes together in the membership. But I want people to trade at their level. SPX to me is I won't call it master level, but it's the big daddy. So you play up there, you need to just know that can hurt you. I mean, it can hurt from the standpoint of I've been here. That trade get breached completely, and that $500 fly out the window. You are like, I'll be a scattered cat, and all you can do is just be like, nah, 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 nah. Yeah, so
You said I'll be a scattered cat.
a scattered cat. Yeah, you could be a salted dog. You could be lots of things when you lose that $500 at one time.
I was thinking a few words, but those were
Yeah,
not them.
those weren't them. I was thinking some others, but I know my phone, this is being recorded, so I did not want to say some of the words I was thinking either. Oh my goodness. Okay, so this is the Peakbot watch list. This is the list I use to determine our the list I used when I put together our list each week. This is where I go to get our list each week. There's a whole lot of stuff on here that's showing neutral. XLE, TLT, Lowe's, Verizon, XLE. Those are the ones that are showing neutral. And notice here, I got the risk is the low risk ones. I like the neutrals because I use these as iron condors. But even though you see this on neutral, it's still something you need to look at on your chart to see if you agree. If you agree that this is a good neutral trade, because it might not be, right? Verizon doesn't necessarily pay a whole lot in premiums, and Lowe's can feel a little expensive, depending on, it's a 2.5 spread. TLT, I don't fool up with them because they trip. The option chain on TLT to me looks too wonky, so I don't like it. XLE is here. The energy sector is also showing neutral. XLU is utilities. Then you got the stuff that's bullish, cost, Costco, gold, Triple Q, which Triple Q and SPY have been bullish for a while. I will be mindful of these for this week. Again, we're going to pull back a little bit this week. I'm anticipating not investment advice, but I'm anticipating a little bit of a pullback here. So you want to be careful whatever you pick, and just want to keep that in mind that it is quad witching week. Microsoft is bullish, Citigroup, Walmart, DIA, XLY, all these are bullish. Home Depot, JP Morgan. And then we got the bearish Exxon, XLF, which is the financials. XLF, the financial is something you might want to watch, because once we hear a response from FOMC this week, that may affect the financials this week, because whatever he decides is the interest rate move, that affects the financials right away. So let's see. Then, and using this, we also use bar chart. How many of you all have been looking at cash secure puts or covered calls? Cash secure puts or covered calls. This is naked puts. Am I sharing my screen? Yeah, I am.
I have looked, and I tried to do one in Sim, but I'm not quite sure I did it right.
Okay.
Sometimes when I do it, it tells me I have Xfinity risk, and it won't let me do anything else.
Yeah, so you can, but it's going to show that your max loss is infinite, because it's showing that, but it's not max loss, because you're going to get the shares. But when you put on a cash secure put, when it shows the risk or max loss, it's going to show infinite, because basically it's thinking if the stock goes down to zero, which is not considering the fact that if the stock goes down below your strike, you're going to get the shares. So you don't have infinite risk. You have the risk of getting assigned the shares.
Oh, so I am doing it right then.
You are.
Okay.
If you're on the screen, the single screen, and you're selecting the bid on the put side, you're doing it right.
Okay.
This is the cash secure put screen. Again, bar chart gives it to you for free. This first screen, it gives it to you for free. I look here sometimes to see which ones are reasonably priced if I don't want to put a whole bunch of money on them. And then when you're here, like QBTS is the quantum, I think I might have this QBTS as one, and I click that little plus next to it so that I can see what is the opinion. This is D-Wave Quantum QBTS, and then I pick opinion. It's a strong buy. I want something that's a buy, so it shows that, you know, the thought is that if you're selling a put, you want price to be going up or at least staying up above your strike. So QBTS is one. Again, this is a $5 stock, strong buy. They are suggesting a 4 strike. I'm not sure if y'all can see what I'm pointing at. Let me circle it here. I'm looking at this one, QBTS. They're going with a 4 strike. The expiration date they give is 1/17, because this is a monthly expiration, so it expires on 12/20, which will be this Friday, and it's going to expire again in a month. They tell you you're going to take in $55 if you do it out to January. So you're putting your, you know, you got $400 is what is 4 strike is $400 minus the $55 you're taking in premiums, means you're putting up $345 of collateral or buying power until this trade is either closed or it expires. Okay, you're putting $345 up. But if you're putting up you're getting $55 for a 400, that's over a 10% return on that money, which is pretty good. Taking in more than 10%, which generally doesn't happen on a cash secure put. You usually don't take in over 10% on a cash secure put. And then you can go up. This is another quantum one, QUBT. RGTI is another quantum. Archer, I think is, what is Archer? I'm trying to remember. I think it's a pharmaceuticals maybe. Oh, aviation, Archer Aviation. You can see the chart here, what it's a little bit, look at the chart, and the opinion is another strong buy. I didn't do Archer, I looked at it, but it didn't have a good premium. So in comparison, I went to something else. SoundHound is, of course, one of our favorites. SoundHound, one of my favorites at this point. It's paying good premiums, and I'm all with the technology. Jamie can talk a lot about what SoundHound is doing. SoundHound, it's a $16 stock right now, so it's not a penny stock anymore. And it's if you look at the 15 strike, now the 15 strike means you're going to put up how much money? How much money we putting up for a 15 strike?
1,500.
1,500.
1,500.
Oh, yep, $1,500. And it's saying you're going to receive 187. So you got 1,500. Subtract your 187. You're putting up like $1,300 of collateral. Okay, you're taking your 1,500 and you're subtracting the 187.
For police?
This is no, this is a cash secure.
Cash secure. Okay, but is that with expiration?
Expiration here is showing 117. Now, SoundHound expires every week, so you really could pick another day. You could pick something closer if you want, and then run it week after week, which is what I've been doing. I run it every week. So that way I'm not waiting till January to close this.
Thank you.
I run it weekly. I also bought some shares of SoundHound before it started moving. I think I got shares in the $9, $10 range, maybe 11. I keep not wanting to remind myself, but I had SoundHound at $4 and Jamie told me to leave it and I didn't listen. I had shares of SoundHound at $4. I sold them.
But if you have at 9, that's still good.
It's still good. It's still good at this point. I'm good, but at $4 would be even the better.
I have some around 450. I still have them. I told my kids to buy them, and neither one of them listened to me. I said, "You see what SoundHound at now, right?"
You know how the children do.
Yeah.
You know how the children do. But yeah, that's what's going on with SoundHound. If you wanted to do it for the month, but like I said, SoundHound is a weekly. Let's look at it. Not investment advice, just showing you what we're looking at. Okay. This is the chart for SoundHound. Come on, baby. There we go. SoundHound was just hanging out down here in the $4 range, and it got on the little horse and started moving. And I think they had earnings. Something happened, an announcement or something happened back here, and it made a big old move. Friday was a doji going which way? It was like the little sword. Went all the way up to 1607. This is the highest it's been. So looks like it closed at $14, $14.95. If you were looking at a cash secure put, we're going to put this on single. You will put this on single. Now, this is what you can do with SoundHound. You can use this one stock and do multiple things with it. I'm going to show you all 3 things you can do with SoundHound. If you wanted to do a cash secure put, you could do maybe, okay, so this is a weekly, not yesterday, of course. Oh, let me turn off. I'm looking at SoundHound like it was yesterday. I mean, like it's not doing its own thing. Let's go back to the chart when the on demand is not running. This is what the SoundHound chart looks like in real time. I still had on demand going. That was looking at this one. It went up here, pulled back. It's been up as high as 17 was yesterday. It went up to 17.29. So if you were looking to chart it, okay, let's look at all the things we've learned so far, peoples. We've learned cash secure puts, we've learned covered calls, and we've learned put and call credit spreads. Okay, this is support at the 1306 in this area. This is a buyer zone for those who use that terminology. This is the support area. Okay, we could look here and say, okay, what can we do here? People who let's interact, not just me. What can we do here around this area? What trades do we see?
Wait, let me.
We determined that it is bullish.
You can do a put credit spread.
We can do a put credit spread. I'm gonna do below 13 might be a little low. There's another support here. Y'all see the other support? Which one did I miss between current price and $13? Those who are on their computers can annotate. Isn't there something in here? Boop, boop.
Or support or resistance?
It would be support because it's now underneath current price. So support and resistance are interchangeable. Yes, your question is a good one. It shows as resistance. It shows as resistance here, but now that price is above it, it's support. It's when you hear Jamie talk about a parity line, I'm not sure why you were tripping. When you hear Jamie talk about a parity line, parity means that it can flip between support and resistance, or a place where it went from resistance or support and change to the other thing. Okay, now
Like support become
give me a
resistant.
line, please. Yes, exactly. This here was resistance over here, right? It's resistance over here in the around 12.9, but now that price has gone through it, now it is support.
Okay.
If and when the price comes back to it, this is a support or resistance line now. Because if price was to come back, the thought is that it would come back and bounce off of it. Just like it came here and bounced off it going back down, that if it goes, it'll now be support. 1512 is what that is around that area. This is the zone. Remember, even though I put one line here, this is a whole zone because price action did go up higher. It went up as high as 16 and some change. If we look here, okay, give me a box. There we go. Price actually went and did the whole thing. It went up higher, right? So it can go up as high as that 1603. Price did this day went up to 16 and some change and pulled back. It closed in the 15 range, but price action did go up there.
So you, with the put credit spread, again, I'm thinking backwards, you still want the price to stay above, right? You're expecting it to go higher. So you want to stay above this, where this used to be support and resistance right here? Would you want it to stay above this?
Yeah, you want the price to stay above that. But you're also saying, I'm going to pick my strike below this because you want price to stay above it.
Okay. So what about if you pick strike like with this last red candle here? Or
That's fine, but you have to watch, depending on where you're going, you got to watch, see, make sure you get good premiums. And this will be a good place, but you want to make sure that if we go with the 13s, which we'll look at the option chain here in a minute. If you go with the 13s, make sure that it's a premium you're okay with, a premium and a probability out of the money. And 13 may be the best spot. You want to be wherever you feel safe. You want to be where you're safe. Okay, looks like we've got something in the 13s, in the 15s, because current price is at 16.90 is where it closed. It closed at 16.91. All right, so we can do a put credit spread here. As we said, we could also do, we got a put credit spread we can do. We can also do a cash secured put. We can sell a put, right? I don't know if I'd do a call credit spread just yet, but if you wanted to, if you were feeling, real froggy, you could do a call credit spread up here, or if you own the shares, you could also do a covered call.
if you own 100 shares.
Own your 100, yep, you can do a covered call, which is what I've been doing, is doing covered calls high enough away that I don't lose my shares. But and if you did happen to lose them, of course, if you've got a covered call higher than your cost basis, then you're going to get all that money back for the shares and keep the premiums. But if you want to hold on to your shares, you want to make sure you get a covered call that's higher than your cost basis and higher than where you think price will go. Okay, these are all the things. We can do a cash secure put credit spread, call credit spread, or covered call. You can do all the things on this. The top part, I'd be a little more leery on the top part, unless you own the 100 shares and get some control. Call credit spread, if it breaches that, then you lose the money. Covered call, if it breaches it, then you just lose the shares and they give you money. So you don't really lose, you just lose. Your shares are exchanged, but they're exchanged for money. Call credit spread, you're just going to lose the money. All right, so let's go to the option chain. Let me clear off what we got here. Okay, we're at 11:30. I've got about 30 more minutes. Okay, let's go. We are looking at, let's see, what's our probability out of the money? We looked at probability out of the money on our call the other day. Like, what does that mean? Probability out of the money means this is the percentage, the percent opportunity that this strike will end out of the money. I try to go with 70 or above, 75 or above, which it shows that the 14 strike is a 77% probability out of the money. And when you're a seller, you want to be out of the money. Remember, this number, though, is dynamic. So once the market is open, these numbers will change. This is not a stagnant number. Like this 77 won't be, it might not be 77 when the market opens. It may not be 77 at 10 o'clock, at 12 o'clock. It all depends on what price action is doing. These numbers are, they move depending on price action. All right. But at this point, since everything is sitting still and we are looking at it for Monday, potentially, we're looking at the 14 strike on the put credit spread or cash secure put side. So bid is the column we're doing. If you're doing just a cash secure put, you would be on the single. You want to be on the single. And you want to do the bid column. Single and bid column. You're picking the 14 strike. If you like this probability out of the money, means you're going to collect $35. You're collecting $35. Okay, we're at a 14 strike. 14 strike means we're putting up $1,400 of collateral and we're subtracting $35 as our premiums, which means we're putting up $1,365 of buying power and collateral. Okay, you're putting up your buying power. If your account has, less than $2,000, it's going to block away this $1,365. If your account has more than $2,000, then you've got margin and the broker is probably going to assist this trade with margin. It just happens on its own. It just happens. But if your account is less than 2,000, then it'll be your buying power only that will carry the $1,365. You'll collect your $35 and let that run for the week. We got just this 1 week, 14 strike, and you're selling a put. Okay, that's at the 14 strike. Now, if you're feeling, a little more aggressive, sometimes people are feeling a little more aggressive, you can pick a different strike. Pick something a little closer, a little further away. If you get closer, the higher you go in strikes, of course, you got to put up more buying power, right? If you get closer, you're putting up more buying power, but you're also taking in more money. But like the 15 strike is a 66% probability out of the money. That means you got a 34% chance that it's going to get here. 34% chance. So that's the balance there, okay? That's if we're doing cash secure puts. We're going to use this same strike, though, if we're doing put credit spread, because we still like this strike. I still like the 77. Put credit spread means we've got the 14 as our sale leg. And we can do, this one is a 50-cent spread, 13.5, taking in $8. I usually expand it to at least a 1 spread. Remember, we talked about this on Thursday. 1 spread, meaning the difference between these two is 1. And you're going to take in $15. Taking in $15 for a 1 spread. So 1 spread, meaning this is what a $100 trade, $100 of collateral minus the $15 you took in premiums, means you're going to put up $85 of buying power for each contract. If you do more, you're going to multiply. If you do 2, you're going to multiply by 2. You're also going to take in double the money and you're going to put up double the money. You do 3, you're going to take in 3 times the money. You're going to put up 3 times the money. Okay, so we've got 13, 14 on a put credit spread if we wanted to use SoundHound for a credit spread. Okay, I covered 2 of the put side. Questions so far? I'm gonna get ready to go to the call side next. Okay, then let's go look on the call side. Go back to single. On the call side, we're saying, what's our probability out of the money above? Now, it's already on a move up, so you might want to give yourself a little more room going up, either 77 or 82. Might want to give yourself a little more room. 77, this is 20 and 21. 20 and 21, depending on which one, how you feeling, right? If you're gonna do a covered call, which means you have shares. What would y'all be comfortable with covered call? Would you want to go with 77 or 82?
82.
82.
82.
Yep. One of the reasons I want you to look at something else here, 82 would be a good place to be, and I'm going to show you why. Do you see the volume here at 21? See the volume here at 21 and the open interest? That's at the 20, sorry.
Yeah. 20.
Right at 20. That means there are 24,000 people who feel like it can get to 20 by Friday. That's how many people have this strike. That's how many contracts have this strike. And open interest means we've got 2,300 that are open. The volume, I always get this mixed up. The volume is where the people, there's interest or there's orders there, and open interest means that their trades are open. And it's at the 20 strike. This big number means there's interest. There's lots of interest here comparatively. Let's see, all these are smaller numbers, and then it jumps to 24,000. So if there's people who feel like it can get up to 20, then you might want to be beyond that. So you can make sure if it does get there, you still keep your stuff. If I got covered calls, I'm going to try to keep my share. Let me keep them at 21, right? So if I pick the 21 strike as a covered call, I already own the shares or a long call. I'm going to collect $56. I'm going to collect $56. Question. This is not really a trick question, but I don't know if anybody's thought about this. I'm going to collect $56. How much money do I have to put up? Am I putting up any collateral?
Just your shares?
Just your shares. You're not putting up any money. Just your shares. You've got to you're basically saying, I want to cover this, and my security is my shares. Okay, so you're collecting.
If it breached, then you would get paid for those shares.
Yes.
And
At
if it
$21.
at the $21 strike price, right?
Yes, ma'am.
56 remains, period. That doesn't change.
True.
If
And I want to make sure that I've clarified something. It's not just if it's breached at 21, it needs to expire there. So generally, if you're in the daytime, like the trade is going during the day and the price goes up above 21, nobody's going to come in the middle of the day and snatch your shares. It doesn't work like that.
Right. I remember now. I remember you saying at one of the trainings that it has, because that was a question I had written down. If it can bounce up and down all over your strike, but if the expiration is what matters.
That's right. Absolutely. Absolutely. So if you're on a Tuesday and it's 21 and the trade, you don't have to worry about in the middle of the day, you're going to look up and your share is going to be gone. You don't have it. The shares movement or whatever happens after hours, and it happens at expirations. And if there's some opportunity, if you want to call it that, or something to go wrong during the week, the broker generally will send you an email and say something like, or a message that your shares are at risk. They'll tell you that, so that way you got the opportunity to make a move. All right, so you would collect $56 here, and you're not putting up any money. If this trade was to expire above 21, then you're going to sell your shares at $21 each. Okay, you're going to sell at $21 each, which will equal $2,100 the broker's going to put back in your account after they take those shares out. If it expires it. And you're going to still keep your $56. You don't lose the $56. That is a covered call. Yes, sir.
Okay, maybe I was asleep on this class. Okay. The price of the stock right now is $16.91. If I brought 100 shares, that's $1,691.
Yep.
If I immediately put this trade on,
yep,
and let's say it goes against me, it's $22. That means that I would have made
yes,
the $2,100.
yep,
which paid for the $16.91,
Yeah,
plus I would have gotten the $58.
yes.
No, something's wrong.
Nope,
What am I
that's
missing?
the way it goes. That's the way it goes. So now the 2,100, of course, is the difference between these two is what, $419, something like that?
Yes,
So your profit is $419
plus the
and you're gonna
58.
get the $56. Yep.
Yeah, 56.
So that's what, $475 of profits?
But the only thing is that, like Ms. Arlisa was telling us, you want to make sure it's 100 shares that you're not going to lose. Like if you get what is it? SoHound?
Mm-hmm.
Sound.
SoundHound. This is SoundHound.
If you got SoundHound at $4 and it's now up to 22, do you really want to risk losing it, or you just want to do cover calls on it? And if you end up losing it, yeah, you'll get the 22, the 2,100 plus the 56, but you no longer have that SoundHound, and now SoundHound could go possibly to 28, 30, or 58. You know, we don't know. So, I mean,
Yeah, but you're still
Yeah.
not losing
You're not
on
losing.
this because
you're
you
not
gotta
losing, no, you're not
rinse
losing.
and repeat.
Yeah.
If you brought it at $4, you just keep rinsing and repeating
Right.
as many times as you can, and the cost averaging over 3 or 4 years,
Mm-hmm.
you're still making more money
Mm-hmm.
than you would have done just by doing
Just
the
by buying and holding it.
PCS, right?
It's about buying and holding. Yeah, you're not losing, that's for sure.
Yep. Yep.
Mm.
This is why people use the wheel strategy, because you can.
Oh, this is the wheel.
This
Okay.
is covered calls, so it's part of the wheel.
Mm-hmm.
So the wheel is you, if you want to, you can do just one part. You don't have to do the whole wheel, but the wheel is where you sell puts. You end up with the shares. Once you have the shares, you sell covered calls. You let the shares get called away, then you sell puts again, yada yada. Or you can just do the covered calls piece, which says I'm going to buy 100 shares, like you just said. I'm going to sell covered calls against it while it's climbing. And then it'll keep climbing. I'll keep my shares. If my shares get called away, then I'll let them go at a profit. That's why you got to make sure that you're picking a cost, a strike price above your cost basis, just in case they do get called away, you will lose them at a profit. But yeah.
Mm-hmm.
This is good for stocks like that you may know are climbing up, but you don't necessarily want to keep them. Maybe you know it's a good climber or it's making good premiums, but you don't necessarily want them long term. But if you do want them long term, you make sure that you pick covered calls high enough that where you feel like it won't get called away. That's just why we talked about using the 21 strike instead of 20. A lot of people are at the 20 strike. So I'm going to pick 21 thinking if all these people think it's going to get to 20, I'm going to go a little bit beyond all those people. So that way, if it gets to 20, I'll still have my shares.
I think also you told us that's why sometimes people get like 200 shares, because then they just play around with that 100, but they know they want to stay in that company, so they leave that 100 to the side or something like that.
I think Miss Valerie mentioned that. I think it was Miss Valerie that mentioned that a couple weeks ago, that you buy 200 of something and trade with one and keep the other one, just let it grow. Yeah. Shanna said, I did this with a firm at $29. I think a firm is like close to 60 now. I made $700, but could have made 3,000 if my shares weren't called. Yeah, that in that case, Shanna, you do something like, if you do it at 29 and your shares get called away, then you go back in and buy another 100 shares. Now that you've got profits, you go buy another 100 and do again. Especially if you believe in the stock's growth, and you continue to, just like Mr. Mack is saying, rinse and repeat. Like SoundHound, I believe it's going to continue to grow. So even if my shares did get called away, I would then go back and buy some more. Same thing with SoFi. I had some SoFi shares I was doing this with, and they got called away for $2 or $3 more than what I had them for. And I just went and bought some more and started the process all over again. Took my profits and started doing cash secure puts again until you get assigned, and go from there. Yeah. Especially if you got something you like it on. So let's go. I'm going to look. The last one, we looked at covered calls. We looked at all of those. Let me go look at what if we did a call credit spread. We're still at this 20 or 21 strike, right? We like the 21, maybe the 20 here if we're doing, you know, either one. Let's stick with the 21 strike. That way we'll keep ourselves in a safe place. Go to vertical. We're at 21, 22. That is paying $9 in credit. You know, you can always adjust this. If you don't like the $9, you can always take this up to 12, I mean, whatever you want to take it to, and then have this order just to sit. 21, 22, let the order sit and work. And if it gets to that price, at least you get the premium that you want. And if it doesn't, then you leave it, right? You don't want to just be trading a trade. We're trading for money, right? This is a one spread again. 21 to 22 is a one spread, call credit spread. And we're going to collect, in this case, we're setting the order for this. We're going to collect $15 on this. $15 there, and we're gonna let it work. But this is, in this case, we need the price to expire below $21. We need price below $21 at expiration in order for us to keep our money. In this case, there's no shares here to do, but you're gonna keep your money. You want to keep the money. $15. Call credit spread. And what you don't have at this point, because SoundHound has not been up here, you don't really have a place that you can say, I believe I've got a zone to use to show support, to show me, you know, to show me that it's been up here before. You don't have that at this point. 1729. I don't think it's ever been up here. I could be wrong, but it don't look like it. Dollar, then it went up as high as 9 and dropped back, went up to 6, dropped back, and then now that it's got moving, it's moving. Okay, so we showed all 4 pieces on what we can do with that one stock, and you could do that on anyone that you really like. I mean, Shannon mentioned Affirm. You know, it's $60 now. So you want a 60 strike now, that's a $6,000 buying power investment. And if you're in something like your IRA, or if you can work your 401k on your own, this is where these kind of strategies are good. Your cash secure puts and covered calls are good there because you're keeping your profits in there. And generally there's more money sitting in those accounts. So you can use safer strategies, good conservative, but they're going to grow. You know, if you grow your if you do a cash secure put every week and take in 5 to 10% every week, you're going to outpace the growth of that 401k or the growth of that IRA by itself, because they're not growing at 10% per week. And of course, I'm not saying that you use all the money in there, but it may take some piece of that they let you use and make some of your own choices. You got SoundHound. SoFi is another one that may be a thought. Y'all know SoFi is my darling, but there's others. You know, the quantum is starting to get real. A lot of people are involved in those at this point. Tesly, TESLY, TSLY. Some of those are in the 20s and 30s, and they're like Tesly, TSLY is based on Tesla. But it's a yield max option income strategy, $17. You got Tesla, you got NVDY, Y max, yield max. There's several on that list. I think I put that list inside of our, I'm not sharing my screen. I think I put that list inside of our Telegram of all the different ones. And these pay dividends. They pay dividends. Some of these pay weekly dividends. So if you own these shares, you could do the owning of the shares. You could sell covered calls. You could be getting, you know, getting money off the growth of it, selling covered calls, getting money off the growth, getting the dividend, all from one $17 stock. And not having to do a whole lot of watching. I have to find that list again and bring it to the bottom. Okay, who's got questions? We're about ready to wrap it up. Affirm is 70 now. Wow. Oh yeah, Affirm, and Affirm I think is gonna keep moving, especially after Christmas. Now, I wouldn't necessarily hold Affirm into its next earnings, because Affirm getting ready to report all the people who haven't paid them their money. They've let a lot of money go out to lend. That's why they've gotten to be real popular. But next earnings call, they may be talking about all the people who haven't paid them. Because there are folks buying Christmas on credit. Christmas on credit. Christmas on credit. Like I'll worry about Affirm later. Oh goodness. Hopefully there won't be too much of that. Hopefully people will pay their bills. Okay. All righty, everybody. Carolyn, you get ready to say something?
Just great lesson. Just now I'm glad the classes are like once a week, because it takes me a week to to process everything, to go back and push buttons on Thinkorswim,
Yeah.
trying to get used to everything. I'm gonna practice everything between now and the end of the year. So if I see anything or notice anything or any problems, I can get in touch with Charles Schwab now before, so because there's time I tried to do a cover call and it says you can't do a cover call. I wasn't this and the account wasn't set up right. I just want to make sure all those bugs are out of the way.
Yes. Yep. Remember, if you're doing a covered call, you have to do the covered call in the same place that the shares are. So if your shares are in your margin account, but you're trying to do a covered call in the cash account, you can't do that. Whatever the account is, wherever the shares are sitting, that's where you have to do the covered call. It has to be in the same place. And many of us have more than one account at Schwab. I have a margin and I have a cash account with Schwab. So wherever you're doing the covered call, the shares have to also be there.
Okay, so with the accelerator that we're going to do as a team and grow as a team, it's best to have a cash account or
margin. You're gonna need margin, because you can't do all the stuff we're talking about. You can't do it in a cash account.
Okay.
So you need to have margin.
Okay, so because I have money in my account now, I just need to make sure it's a margin account is set up correct. Okay,
Yep.
that's what I'm going to be doing this week. Make sure that it's a margin account.
Yep, make sure it's margin and make sure it's set up like you said. Okay. Jamie, you have anything you want to add? Have I missed something?
The only thing that I would add is if anybody's going to use multiple strategies, it would be a good idea to make sure you have some type of trading journal to be able to keep track of these different strategies. If you're doing the same ticker, but you're using multiple strategies. So, for example, if you're going to do a cash secured put with the intent of doing a covered call, that means you're going to need to know what your cost basis is, so that when you do your cover call, you know what you're covering. However, if you're going to use the same ticker and also do either put credit spread or call credit spread, then you want to make sure you're keeping those numbers separate on the sheet, however you want to track it, sheet of paper or whatever you do. But just know that it'll be very vital keeping track of those numbers if you're doing multiple strategies on the same ticker. Because the reason why I'm saying it is because regardless of how we track it I'm gonna use a phrase on paper, but however you track it, when you're looking at it in your account, those numbers are always jumping, right? So like your cash available, your stock buying power, your options buying power, those numbers are always jumping. So it's important to at least know what that number needs to be. So it'll definitely help to be organized on that side, just to be on the safe side.
I'm glad Jamie's bringing that up, because I'm going to create a journal that we can use for the accelerator, where we can keep up with all of our stuff.
The other thing would be that I would say would be, I would be very careful about using YieldMax for any type of trading for income, opportunities. I think that they are great for buying for dividend purposes. But if we were to measure them, if we were to measure a lot of those up against how we measure regular stocks, some of those yield max tickers have not even been around a year and a half, 2 years yet. So if we were comparing it to like a regular stock ticker, a regular company, we don't have the data. Some of those probably haven't even been around. I don't even think some of them have been around the full 2 years yet. Also, those yield max, there's a Tidal, there's a Defiance, there's a group of them. Those are not a regular, those don't operate like a regular tickers. Those are options income. So technically what's happening in that situation, NVDY, TSLY, what's really happening is the company is making the options play. Mm-hmm. And you're getting paid out of the dividends, or I'm sorry, you're getting paid dividends based on the options play that they're making. That's why it's categorized as options income. Mm-hmm. So the company itself is creating an options. They're using an options play to generate the money anyway. So those operate a little bit differently. Mm-hmm. It's based on the price. For example, I'll use NVDY as an example. So NVDY is based on the movement of, actually I'll use CONY because that's my favorite. CONY. CONY is based on the movement of coin, right? Now I know that I know that coin, which is Coinbase, is based on the movement of Bitcoin, right? So I know that when Coinbase is going to go up, because Bitcoin is going up, my dividend payment is probably going to be going up for that month, right? So it's not you can still track it the same way, look at the chart and all the other stuff, but I'm saying the dividend payment itself changes, depends on what happened that previous month. Whereas most of our other tickers are like quarterly, things like that. This is a monthly paying dividend stock, but it will definitely change. It's not based necessarily on what the quote unquote company did for the previous quarter. It's not based on those kind of numbers. Mm-hmm. Meaning what what CONY did as a company, because CONY is not a company, it's an options play, right? That YieldMax is using. So it's important to note the distinction between those two, because you're not doing fundamental analysis on CONY. That's not. It's an options play, mm-hmm. but because you own a share in that play, and I'm simplifying it, but because I own shares in that play, I'm getting dividends on it. So if you go into if you go to finance.yahoo.com and you go and type in, any of them, TSLY, NVDY, CONY, and you go into historical data, if you click and switch it to dividends, there's like 2 or 3 under there where it shows you all the recent numbers or whatever. But if you switch it to dividends, it'll just show you just the dividend payments. So you'll see what I'm talking about. Each month over the past year and a half, whatever, that amount is changing, and you'll be able to look at a chart and see where, coin might have been up this particular month or however it works. Okay. So I'm just letting you know that, because my first idea was to use it to trade those for income. And then I realized it was probably better to buy those for income, because all of those don't even have, a lot of those don't even have, you can't really do leaps on those, as an example. All of them don't have it available yet. Let me say it that way, where you can even do leaps on those. So I'm not saying don't use them. I'm just saying, be careful and do some research on those, because they move and their purpose is a little bit different.
So you see the list I have on the screen, it shows you here as the inception date. This is in the Telegram. The, like, for NVDY was opened in May of last year. And CONY, the one Jamie's talking about, was opened in August of last year. But like MSTY, which is based on MicroStrategy, it was opened in February of this year. Right, so you can see here the inception date of which of them. There's one for Netflix, Meta, Amazon, PayPal, Palantir, Snow. There's one, Yield Max or Yield Mag is the 7, basically on the Mag 7. There's one here. It was opened this year in January. Tesla has one, Microsoft has one. Yield Max or YMax was opened in January of this year as well. You can see there's all one for Disney, Apple, JPM, AMD. Bitcoin has one, YBit. It was opened up this morning, this April. Feels like it was this morning, this April. So you can look here at this list. I put it in the Telegram so you can see the inception date. Just gives you a place to start your research if you want. And you can, maybe the ones that were here last year, they've been around a little bit longer. They at least give you some historical data. This Tesla one was opened in 2022. So that looks like it may be the longest one. That one and the innovation option income for OARK, OARK, is also 2022. But the Tesla one, TSLY, it was opened in November of 2022.
And so that's what I was meaning by, like, if we were comparing it to a regular stock ticker, we would be like, yeah, we're going to get us some time before we start trying to trade it. But it moves a little bit different.
Yeah, and if you're buying it, like you said, then you can buy it for the dividend.
Yeah, so but that historical data on finance.yahoo.com is, as soon as I see a new one, I'll find out one that's listed. With these, that's the first one that I'll go and check.
Yeah, that's Tesla. Looks like it's even monthly. They're monthlies. They're not even weeklies.
Actually, there are some that are weeklies, and that's what I was saying. Like, some of them, UMX has 2 of them that used to be monthly that they recently converted to weekly. Personally, I don't like the weekly ones. But I won't get into that. But they do have a mixture of both. So just be aware of that when you're researching them. And it's not just YieldMax. Like I said, there's a company called Tidal that has some. There's another company called Defiance that has some. And when I say some, I mean that's have this options income, the same vein. And usually you'll see their names, meaning Tidal and Defiance, when if you're on anywhere you're looking and you go to look up, let's say CONY, and then there'll be a section to show you what else people are trading. You'll see like Defiance and Tidal, JP, I think it's like JP, JEPI. There's like a couple other ones that are out there. There's more than a couple, but so there's a bunch of Robinhood especially will show you the names of other ones as well. So just be aware of those.
All righty. All right, thank you for that. Mr. Mack was just asking about leaps. So I just real quick look at, this is SoFi. SoFi, of course, is at $16 right now. If you wanted to look out at a leap, I'm a fan of buying them at the money or in the money if you can. So this is January of next year, January of 2026 would be here. And you see if you bought at the money, it's $450 for a 17 strike. And if you wanted to go one down, it's $525 for the 15 strike. And then you can use leaps to sell calls against as well. If you make sure you're in your margin account, you can actually sell, higher than higher than your strike, of course, and you can go on up from there. But you see something like a SoFi, if you've got something, that you think you have a strong view of, you got SoFi as one of them. I mean, if we talked about SoundHound, you're looking at, it's almost a $17 stock. 17 strike for next January is $700. buy something, at the money, in the money would be my suggestion. If you want to go with something that's, a little more expensive, let's say we were just talking about Affirm, not sure if that's something you'd want to get, but if you're looking, the price changes, you go out that far. Now we're talking about 72 or 70 strike is $2,300 to purchase that. So you want to keep in mind that's a $70 stock. It's costing $2,300 to buy a Leap for next January. Of course, you can come in a little closer in time. Maybe you go into June, July, September, something like that. The price will be a little cheaper the closer you are. But, I'm looking now, I'm learning some stuff about strike selection and like date selection for Leaps. Because I mean, what I know is just to buy at the money or in the money, something that I think has long-term potential. And it doesn't really, I mean, you don't have to necessarily be like timing that entry so perfect. It is good to buy on a pullback, but you don't have to time those entries perfectly because you do have time on your hands. But you do need to have like a thought. What are you planning to do with it? Do you really have strong conviction about them? I was wondering if Bar Chart had something about Leaps. Does anybody ever looked on Bar Chart for Leaps? I don't see anything here that mentions Leaps. That would be something to see if there's a screener that kind of talks about longer term things. The ETFs are here. I don't see anything. If anybody's heard of a Leap screener, let's talk about it. I don't think I've heard that. And maybe, of course, once you start looking for something, it shows up. That's the way that goes, doesn't it? All righty, but we'll talk more about Leaps subsequently. All righty, we've been here a couple hours. I hope everybody has gotten good value out of our time together this morning. I will be on YouTube live tomorrow evening at 5, live at 5 on Sunday. We'll do that and go through our list and all those good things. You all are free to ask whatever questions you have inside that Telegram. If you haven't if you haven't scheduled your time, please do that so that way you can get your 15 or 20 minutes of one-on-one time so I can get a good idea of where you are and where you're trying to go. All right. Okay, everybody have a good afternoon, a good evening. Enjoy the rest of your day, and we'll talk in tomorrow. Okay, hasta mañana.
Thank you. Bye-bye.
Bye-bye. Goodbye, everyone.